90% of professional fund managers fail to beat the market over a 20-year period. Let that sink in. The people paid millions of dollars to pick stocks, the ones with the fancy suits and Bloomberg terminals and Ivy League degrees, they lose to doing almost nothing. And yet, somehow, they convinced you that you need them. Here's what they don't want you to figure out. You don't. Most people think investing is complicated. They think it requires constant monitoring, special knowledge, a financial advisor on speed dial. So they do one of two things. They hand their money over to someone who charges them fees they barely notice, or they do nothing at all and let inflation quietly eat their savings alive. Neither of those is building wealth. Both of those are making someone else rich instead of you. The solution is something called an index fund, and it is genuinely one of the most powerful wealth-building tools ever created. Here's how it works. Instead of trying to pick the right stocks, an index fund simply buys all of them. Or at least, all the stocks in a specific index, like the S&P 500, which tracks the 500 largest companies in America. Apple, Microsoft, Amazon, Google, they're all in there. When you buy one share of an S&P 500 index fund, you instantly own a tiny piece of all 500 of those companies. You're not betting on one horse. You're betting on the entire race. And historically, that bet has paid off. The S&P 500 has returned an average of about 10% per year over the last century. That means if you invested just $500 a month starting at age 25 and never touched it, by the time you hit 65, you'd have over $3 million. From $500 a month. Not because you were a genius stock picker, just because you showed up consistently and let the market do its thing. Now here's where index funds really punch above their weight. Fees. Active mutual funds, the ones managed by those highly paid professionals, typically charge between 0.5% and 1% or more in annual fees. That sounds tiny until you realize those fees compound just like your returns do, but in reverse. Index funds, specifically ones from providers like Vanguard or Fidelity, often charge as little as 0.03%. That difference in fees over 30 years can cost you tens of thousands of dollars, sometimes more. The rich know this. That's why they use index funds for their own money while selling you something more expensive. So what do you actually do? First, open a brokerage account if you don't already have one. Fidelity, Vanguard, and Schwab are all solid options with no account minimums to get started. Second, if your employer offers a 401k with a match, start there. That match is free money, and you should take every dollar of it. Third, look for a total market or S&P 500 index fund inside your account. Tickers like VOO, FZROX, or SWTSX are popular ones, but always check the expense ratio before you buy. Anything under 0.1% is excellent. Fourth, set up automatic contributions so you invest consistently without having to think about it. The best investors aren't the smartest ones. They're the most consistent ones. And that's really the whole secret that nobody wants to say out loud. Building wealth isn't about being special or having connections or knowing the right people. It's about understanding a few basic principles and applying them repeatedly over time. Index funds are the vehicle. Time is the engine. You just have to start. The longer you wait, the more expensive that wait becomes. Every month you're not investing is a month of compound growth you'll never get back. If this video helped things click for you, subscribe right now because we break down money concepts like this every single week. No jargon, no fluff, just the stuff that actually works. Your future self is going to thank you for it.